Welcome to The Explainer. If you've ever felt totally overwhelmed by the daily chaos and just the relentless noise of the stock market, trust me, you are definitely not alone. Today we're diving into some really fascinating source material that maps out a highly visual guide to mastering moving averages. We're going to see exactly how this tool can help us cut through all that panic and actually find the true underlying trend. Let's get right into it.
Okay, let's dive into this. Think about how most people interact with the stock market, right? They open up their trading apps, they see an absolute sea of red, and they panic. But checking your portfolio every single day to try and figure out the market's direction, it's literally like stepping outside every single hour to figure out what season it is. I mean, if a random cold front rolls in during July, you don't immediately run out and start buying winter coats, right? Of course not. It's just a temporary drop in temperature. But in the stock market, people react to that hourly weather check constantly. They get so caught up they completely lose sight of the bigger question. Are we in summer or are we in winter?
Look, if you just rely on an hourly temperature check, it's chaotic, it's totally distracting. The temperature spikes in the afternoon, it drops at night, it fluctuates with literally every passing cloud. That, my friends, is pure market noise. But if you take a monthly average of those temperatures, all that daily volatility just completely disappears. Suddenly, this clear curve emerges revealing the actual season. You get the signal, not the noise. And, well, that brings us directly to the specific mathematical tool that does this exact same thing for your investments.
Section 1. Defining moving averages. So to find our seasonal compass in the market, we turn to the moving average. It's this foundational tool that strips away the daily emotional reactions of buyers and sellers. It leaves us with just cold, hard data about where a stock is actually heading. And honestly, it is surprisingly simple to calculate. And moving average is just the average closing price of a stock over a very specific number of days. So, for example, a 50-day moving average, it simply adds up the closing prices of the last 50 days and divides by 50. Then tomorrow, it drops the oldest day, adds today's closing price, and calculates the new average. The absolutely crucial rule to remember here is that the longer the period you measure, the smoother and slower the line on your chart is going to be.
And this brilliantly illustrates an amazing analogy from our source material by Dr. T. Think of a short-term moving average, something like the 10-day or 50-day line, as a small boat. It's highly responsive, right? It turns super quickly when the waves change, but because it's small, it also gets tossed around a ton by volatility. Now, compare that to a long-term moving average, like the 200-day line. That thing is the Titanic. It is slow, it's massive, and it takes a whole lot of time and energy to change direction. But when that massive ship actually turns, you know for sure a major fundamental shift is happening.
Section 2. The long-term value line.
So that massive ship, the long-term moving average, is exactly what long-term value investors use to establish their baseline. It acts as a compass to find historically undervalued opportunities in the market. Our source actually calls this the value line. Depending on the chart you're looking at, this is typically the 5-year moving average on a monthly chart or the 200-day moving average on a daily chart. And the application here is just beautifully simple. When the current price dips significantly below this line, the asset is historically undervalued, it's on sale. But when the price is floating way up high above this line, it's historically expensive. This single visual strips away all the complex financial jargon and honestly provides more actionable signal than dozens of complex indicators combined.
Section 3. The Golden Cross. Now, what's really interesting about this next slide is that we're looking at the absolute most powerful buy signal in the market.
When we put the small boat and the Titanic on the exact same chart, we are looking for one specific moment: the Golden Cross. This is literally one of the most famous and highly watched technical signals in the entire financial world. It happens when the short-term moving average, usually the 50-day line, crosses directly up and over the long-term moving average, the 200-day line. So what is this actually telling us? Well, it means the recent short-term momentum of the stock has officially shifted from bearish to bullish. It's mathematical proof that the sellers, the bears, are losing their grip on the market and the buyers are firmly taking control.
If you want to know why investors care so deeply about the Golden Cross, we really just have to look at history. According to our sources, this exact signal flashed on the S&P 500 back in June 2009. And guess what? That signaled the beginning of the longest bull market in history right after the financial crisis. It flashed again in April of 2020, which was just weeks after the absolute bottom of the COVID-19 market crash. Both times, this single crossing of two lines preceded the two most historic buying opportunities of our entire generation. Pretty wild, right?
Section 4.
The death cross. Now, as we all know, the market isn't always going up, which brings us to the exact opposite of our last indicator, the death cross. Protecting your capital is just as important as growing it, and this right here is the ultimate warning signal. As the name implies, it happens when the short-term 50-day moving average crosses below the massive 200-day moving average. When the small boat sinks below the Titanic, it's basically indicating that short-term momentum is dragging the long-term trend down with it. The bears are officially taking control of the chart.
When you see a death cross, our sources highlight exactly what it means for your strategy. It is a strict signal to reduce positions, tighten stops, and move to cash. Listen, it's not a suggestion to just wait and see. It is an active, serious warning to play defense. For some context, this exact pattern appeared on the charts in late 2007. That was literally months before the absolute worst devastation of the 2008 global financial crisis hit.
And the stakes really couldn't be higher here. Those who saw that 2007 death cross and actually acted on it by reducing their positions and moving to cash, they protected their hard-earned capital. But those who ignored the data, the ones who listened to the daily noise instead of the long-term signal, they lost 50% or more of their entire portfolios in the months that followed. Half of everything they built just gone.
At the end of the day, moving averages aren't about predicting the future with some magic crystal ball. They are about clearly understanding the present. By stripping away the daily noise of those hourly temperature checks, you can finally see the true seasons of the market. So as you review your own portfolio today, I want you to look past the red and green numbers flashing on your screen. Go ahead and draw the 50-day and 200-day lines. Ask yourself, are we in summer or winter? Have you seen a golden cross or a death cross lately? The bears or the bulls, who is actually controlling your chart right now? I challenge you to go find out. Thanks so much for joining me on this explainer, and I'll see you next time.